The Accumulation Distribution Indicator, sometimes shortened to the AD indicator, helps measure the strength of a trend. It assesses volume along with how price closes in relation to the highs and the lows of candles in order to indicate which way the market is going or preparing to go. It tells us if there is accumulation or distribution of a particular asset. In the case of accumulation, this usually points to more buyers and an increase in price. In the case of distribution, there will often be selling leading to a decrease in price. Like with most all indicators, computers will be doing the calculations, so if you want, you can find the formula for the calculation of the AD indicator for yourself. Similar to other lessons on chart indicators and tools, the main focus here will be on examining real chart examples, rather than just outlining diagrams. We'll see the various uses of accumulation distribution along with preferred conditions for its application in cases where it fails and/or has limitations. No matter when you watch this, the information can generally be applicable regardless of the time frame or time period. Though in terms of which types of charts the accumulation distribution indicator works best on, it would generally be charts from the stock market due to the aspect of volume. Volume on stock charts is more centrally reported, unlike on some currency charts. That's just a quick note to make now. Let's get to the example case studies. The accumulation distribution indicator and price will often move in the same direction at the same time. This points to sufficient strength for a trend in terms of volume. For example, this uptrend with more than enough volume continually closes higher to make consecutively higher peaks and troughs, while at the same time the AD indicator forms higher highs and higher lows in an uptrend of its own. Depending on volume and price action that form certain types of candles, the line formed by closing prices and the line formed by the AD indicator can have slight variations, especially in the short term. In the broader context, with an uptrend like this, the overall direction is the same with the AD indicator and price. With the black line representing price, it can be useful to choose an option that marks the closing prices. In this case, each dot represents the closing price of a particular day. When there are reversals, smooth changes in the direction of price will often be mirrored by the direction of the AD indicator. Viewing a line chart with closing prices marked can sometimes be more intuitive during the slower portions of a trend where a candle chart might appear to display more flat movement. Divergence with this indicator is a term that simply refers to the indicator moving in the opposite direction of price. It can point to the weakness of a trend in terms of volume, as well as how price is closing in relation to the highs and lows of candles. This is said to be a precursor to a reversal when price and the AD indicator will eventually be in sync and move in the new direction, in this case the shift towards a downtrend. Essentially, another way to summarize some classic characteristics of reversals, where there's a decrease in bullish volume followed by an increase in bearish volume, and bearish candles with longer upper wicks eventually transitioning to large red bearish candles. The last few days see the indicator move down sharply, while price still manages to open at newer highs. That's because the closing prices are more important and they generally close lower. At first glance, it may seem like an upward reversal is taking form, but it would be important to remember there was already an existing uptrend with recent bearish signs. A few green candles with AD also moving higher is not sufficient, especially without closing above the previous highs. Again, there can be some variation and discrepancy between the AD indicator and price movement, especially in the short term when there are some unusually large candles with high volume contrasted by periods of relatively flat movement with candles that are much smaller and with lower volume. In the bigger picture, it's more important that price and the AD indicator generally move downwards with consecutively lower lows to identify and confirm the formation of a downtrend. Looking back at that minor bullish to neutral phase, we can see price didn't close above previous highs, while the AD indicator went on a much steeper uptrend past its recent previous highs. This kind of discrepancy can also point to the weakness of movement, in this case the weakness of a minor uptrend within broader bearish context. Similar to the end of the last example, a minor increase in price takes place during an overwhelming downtrend, and during this minor bullish to neutral phase, the AD indicator is on a much sharper incline in comparison to price. Generally, you don't need to change any settings or look at the exact values of the AD indicator. We're mostly interested in the basic direction AD moves in relation to price in the short to medium term. So looking at precise values of this indicator is usually not necessary. Given the continuing bearish context in the medium and short term, this recent appearance of relatively neutral flat movement with the AD indicator and price points to a minor retracement before the increasingly likely continuation of the downtrend. Given the smooth synchronization of the AD indicator and price, both sliding down in the short term moving into December, which is in line with the broader context to generally form lower lows and lower highs. both in terms of closing prices and the AD indicator, which, as we've seen before, can identify and confirm the strength of this downtrend. Now, as price makes a minor rebound, the AD indicator also moves up slightly to agree with the potential for at least a minor bullish reversal. For extra confirmation towards a stronger upward reversal, we'd be looking for higher troughs and peaks for both price and the AD indicator. Overall price has remained relatively unchanged while AD has arisen noticeably. This is because even though the majority of candles have been small and relatively flat in terms of movement, they've mostly been green with above average volume, and they also have relatively short wicks. The AD indicator is pointing to accumulation with buyers entering the market and raising price like lately in the short term. This points to growing strength for the potential bullish reversal. For confirmation of a more decisive uptrend, we would be looking for the AD indicator to keep rising and for price to eventually catch up with a steeper incline, followed by the familiar characteristics towards a more developed uptrend with consecutively higher highs and higher lows. In this case, such features are more apparent with the AD indicator due to the straighter and more uniform movement of price action. Here's another instance where there is flatter range-bound movement for both price and the AD indicator. But if we look in the short term and the broader context, we see some discrepancies where price is falling, while the AD indicator continues the existing incline. Moving into March, this divergence gives way to a distinct reversal which is eventually confirmed with price and AD moving in the same downward direction at the same time. And when there's a minor rebound shortly after things begin to flatten out, but there's still a distinct downward slope, though it's nowhere as strong as the overwhelming downtrend at the beginning of this example. It's a more gentle decline better described as neutral to bearish movement, with the minor upswings lacking strength as seen by price being unable to close over previous highs, while AD does move over previous highs slightly, though it still does remain relatively flat at these previous highs in the broader context. As would be expected, a large green candle with high volume and short wicks would be accompanied by a sharp increase of the AD indicator. The AD indicator doesn't do a good job of accounting for gaps. Price technically closes higher compared to the previous day, yet AD falls slightly because the most important thing is the closing price of the candle in relation to the high and the low prices, in addition to the proportions of the candle body and wicks. The next day also technically closes higher compared to the previous day, but there's an even sharper drop due to there being a larger red-bodied candle closing lower in proportion to its high and low prices. And when price closes down and there is a gap down, there's a natural decline of the AD indicator, which is more intuitive. Now watch AD increase while price technically closes lower. This happens due to a green candle forming after a minor gap down. Again, the closing price of a candle in relation to the proportions of its body and wicks is more important than a gap. This also demonstrates how a divergence of AD and price action doesn't necessarily mean an immediate reversal will take place. When there are narrow gaps or no gaps at all, it's quite intuitive, and there's no discrepancy with the smooth transition to a reversal. With the current minor upward retracement, there is a fairly large divergence in the short term due to this gap up and longer upper wick, in combination with the contrasting large red body candle with higher than normal volume. Then when there's an absence of noticeable gaps between candles and the price closes downwards uniformly, it's a flatter decline of AD due to there being only a minor overall decrease in price over the past 3 days. Along with the volume rapidly decreasing, price and AD continue to get back in sync and move in unison towards an overwhelming bullish continuation that's helped by large green-bodied candles and increasing green volume. Looking at the bigger picture, the overall trend is still up for both price and the AD indicator, even though in the short term, those 3 red candles did have a major impact in dropping accumulation distribution values at the beginning of 2021. Moving ahead, there's now a minor drop of closing prices in the established uptrend, while AD has been dropping overall. The discrepancy lessens, but there's still an overall drop of the AD indicator, which is moving flatter now, while price continues to gradually increase. Finally, price and the AD indicator get back on the same page in terms of moving in the same direction, leading to the identification and confirmation of a strong uptrend continuation. The shift to a downtrend is quite orderly, with no major discrepancies between the AD indicator and price, due to the highest closing prices coming from green candles, which are immediately followed by a large red-bodied candle, with almost no upper or a lower wick and narrow gaps between the candle before and after it. After a noticeable gap, there's a green candle which causes a disconnect with price dropping, but AD remaining relatively unchanged. This would be different if it was a red candle following the direction of the drop, But within no time, there's a row of green candles which firmly place the AD indicator and price back in the same direction. Then there's a minor discrepancy where price is remaining relatively unchanged, but the AD drops due to low volume and relatively small candles, with the proportions of small bodies and relatively balanced upper and lower wicks. It's a familiar characteristic we've seen with retracements that take place before another continuation carries the trend forward. Now, with volatility increasing noticeably, a downward reversal does become more likely with the emergence of higher red volume, and the price starting to consistently close lower in conjunction with a consistently falling AD indicator. Large red-bodied candles with higher than normal volume help to avoid any divergence between price and the AD indicator during this progressing downtrend. With a swift bullish reversal, we see there's a minor divergence between the AD indicator and closing price. But it would be quite sensible to have ignored this, given the overwhelming bullish context in the transition to October. Another situation here where minor to moderate gaps don't see any major divergence between the AD indicator and price, due to these candles also being large red-bodied candles with small wicks that are dropping in the same direction as these gap downs. There is a minor exception here where the purple arrows are pointing to, due to the proportionally longer lower wick and increased red volume of this candle, that in itself could point to the possibility of an upward reversal. But that would be a low possibility given this single factor, in addition to the fact that price immediately closed lower in the following few days. Eventually, this minor upward retracement gives way to a bearish continuation. And that's not too surprising, given that the AD indicator and price don't get back anywhere near their previous highs, followed by red volume at normal levels, easily taking down both price and the AD indicator. At this potential bearish reversal point, there's no divergence, even though there is a gap and a red candle for the peak, due in part to the proportionally longer lower wick and highest volume on this peak candle. Later, when there's a downward acceleration to this new trend, there's no divergence, even though there's a noticeable gap, which is again due to the red candle falling in the same direction as the gap down and having a large red body, and having little to no upper or lower wick. The following movement is relatively flat and comprised of small candles, but the overall trend is still downwards for both the AD indicator and price, providing further confirmation of the residual strength of this ongoing downtrend. Similar to previous downtrends, we see these characteristics on a smaller scale with these spikes in volume and red candles. Near the beginning of October, there's that minor gap down which causes some divergence even though the candle is red. This is due in part to the proportionally longer lower wick and the relatively small body, along with a still high level of red volume, similar to previous examples during periods of increased volatility, but relatively unchanged price. It can be helpful to sometimes look at both a candle and a line chart to better see areas of divergence and synchronization between price and the AD indicator. This is helpful for both identifying potential continuations of a trend or a complete reversal. Similar to drawing trend lines on a price chart, drawing a trend line on the AD indicator can also help to identify potential breakout areas with sharper price movement that could be accompanied by higher volume and more aggressive price action. Though this is an additional and secondary use of the AD indicator, which is less reliable, especially when you use shallower and longer-term trend lines, in comparison to the AD indicator's normal use of identifying and confirming trend strength. Although some of these drops have gaps, there are no major divergences with the AD indicator, especially with these three large red-bodied candles with small wicks that drop in the same direction as the gap downs and the larger downtrend. Drawing a trend line from the start of the next uptrend isn't very useful due to stretching for a longer duration and to a lesser extent being on a shallower angle. Focusing on a shorter time frame tends to have the AD indicator better identify larger breaks, such as this one. And it's a similar situation here when the larger bearish reversal begins. Now here's an example where there's divergence right at the start of the new year. It appears AD is falling while price continues to rise. Rather than leading to a full bearish reversal, it demonstrates how the trend can weaken briefly prior to a continuation. And divergence between price and the AD indicator certainly helps define this area. When a downtrend does take place, we see a familiar instance where a large drop of the AD indicator takes place, while there's little change in price. This is mainly due to high selling volume along with a proportionally higher upper wick compared to a small red candle body. Later, we can see the opposite taking place with a small green candle taking AD significantly higher due to its proportionally smaller body in comparison to its long lower wick and high volume. When the downtrend line of the AD indicator is broken, it helps confirm the approximate breakout area and the continued strength of this new uptrend. Drawing resistance and support areas, especially during a range-bound period, can be useful, but it's more of a secondary use similar to drawing a trend line on the AD indicator. In this case, there's divergence where price continues to move relatively range-bound while the AD indicator breaks significantly higher. This disconnect eventually leads to some bearish accelerations under the price range. Interestingly, shortly after the opposite takes place, and eventually results in the convergence of the two in the same general direction. Similar to how peaks and troughs don't always form uniformly between the AD indicator and price, the same could be said about the breaks of trend lines, which can take place at different times and places even though the trend lines are drawn from the same points. That's why using AD in this way to identify breaks is a secondary use and not a primary analysis method. After all, the accumulation distribution indicator is meant for the identification and confirmation of a trend strength, and to a lesser extent the possibility of a reversal when there's some divergence between the AD indicator and price. The main use of the AD indicator isn't to identify areas where breakouts could occur. In the case of breakouts accelerating a trend further, it's more appropriate to use the AD indicator to confirm the strength of the breakout carrying the trend further. Marking trend lines and areas of interest on the AD indicator is optional. It's best to stick with the primary uses of this indicator. Optional use of a trend line on the AD indicator works fairly well here, since it's for a short duration and on a steep angle. The gap up isn't so important in this case, but rather the period of indecision that immediately follows it. Not surprisingly, we see familiar characteristics, which include higher volume and noticeable divergence between the AD indicator and price movement. When there is, eventually, a successful reversal, we see a case where there's no reversal following a major divergence of the AD indicator and price. It highlights the importance for looking at further confirmation of a reversal, and reminding us that a divergence doesn't always guarantee an immediate reversal. A familiar scene here, price gaps down to close lower, but there's divergence with the AD indicator moving higher. This is because it's a gap down, and there's a large green candle. A good example here where a trend line isn't so practical to apply on the AD indicator. In contrast, here's a good example where a trend line and support area help identify the bearish continuation to this trend, which is actually weak, as seen by the relatively flat movement after the initial break below the line, and increasingly bullish movement with the AD indicator and price. With sustained divergence after the sharp peak, the second lower trend line on the price chart becomes more relevant. Overall, these circumstances point to a weak to moderate downtrend. Later, when the trend line on the AD indicator is contacted and eventually broken through, there's no immediate follow-through with both price and the AD indicator dropping. Instead, they both move neutral to bearish, showing further weakness of the bearish movements during this time period. Overall sustained divergence of the AD indicator and price after some sharp peaks summarizes the period of a weak downtrend, which can now be more easily seen with the period of low volume and weaker bearish price action. For more on technical analysis with indicators, as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.